Welcome to our channel, where we discuss finance and financial strategies designed to help you build strong financial foundations, stabilize your current finances, and support long-term financial growth toward financial freedom. If you need professional support with CFO services, account management, financial operations, financial modeling, financial planning, and more, feel free to reach out to us.
Yeah, and today we are actually jumping straight into the next part of our ongoing discussion. We are breaking down an excerpt from Chapter 4 of the ebook Stock Investing 101, and we're talking all about how to find incredible companies that are basically trading at a discount.
Right. And really quick, if you are just jumping in now, you might want to check out the previous part of this series just for better understanding, but you can definitely still follow along with us today, because today is essentially a financial treasure hunt.
It really is, and we have to start with this incredible psychological blind spot that the book points out. It's so ironic.
Oh, the TV analogy, I love this.
Yeah. So think about what you do when you want to buy a new flat screen TV. You'll probably spend, 3 solid days researching the refresh rate.
Oh yeah, you're watching a dozen YouTube reviews. You're on Reddit arguing with complete strangers about whether an OLED screen is actually worth an extra $500.
Exactly. But then you'll turn right around and buy shares of a publicly traded company, which literally means you are buying a piece of a massive multi-million-dollar business, and you'll do it with less research than it takes to pick a movie on Netflix.
Which is wild.
Right. We apply all this intense scrutiny to consumer goods that will be basically obsolete in 5 years.
Yeah.
But with our actual wealth, we just default to whatever ticker symbol is trending.
So our mission for you today is to bridge that gap. We want you to step out of that passive consumer mindset and step into the shoes of a business owner.
Because finding a truly exceptional company is hard. But finding one that is temporarily on sale, that's really rare.
Okay, so let's unpack this. We should start with probably the most common piece of investing advice ever, which is invest in what you know.
Yeah, which sounds great.
It sounds super logical, but the book makes it very clear that relying only on familiarity is just a massive trap.
Oh, it's a fast track to disaster. I mean, familiarity is a good starting point, but it's not a complete strategy. Let's look back at the year 2000.
Oh, boy.
Right, so if you built a portfolio back then using only surefire brands that everyone knew, what were you buying? You were shopping at Sears. You were surfing the web on Netscape.
You were buying Kodak film for your camera, driving a General Motors car, flying Delta.
Exactly. And if you bought those foundational names just because you recognized the logo on the building, you would have been wiped out. All 5 of those massive companies went bankrupt in the following decade.
Well, Delta survived through reorganization, and the book makes this joke too. If you want a business perfectly designed to just torch piles of cash, airlines are a solid bet.
Oh, definitely. And this leads right into Warren Buffett's core rule. You do want simple businesses, but they absolutely must have a competitive moat.
A moat, like around a castle.
Right, a protective barrier that keeps competitors from stealing your profits.
So, wait, if I buy a stock just because I know the brand, but there's no moat, it's basically like buying a house just because you like the color of the front door, completely ignoring that the foundation is actively sinking.
That is a perfect way to put it. Or think of it like owning a toll bridge over a river. If it's the only bridge, you have a huge moat. People have to pay you.
Because they have no other choice.
Right. But if someone can just build a cheaper bridge right next to yours, your moat is gone. Sears, Netscape, Kodak, they lost their bridges.
Because Walmart built a cheaper bridge than Sears. Microsoft crushed Netscape by giving Internet Explorer away for free.
Exactly. So to spot a real moat, the book gives us 4 specific questions. First, will people pay a premium? Are they happy to pay more just for the brand?
Like Apple, right. People gladly pay way more for an iPhone just because it's Apple.
Exactly. Second is switching costs. What do you keep paying for just because leaving is a huge headache? Think about your bank account.
Oh, changing direct deposits is the worst. I'd never do it just for a slightly better interest rate.
Right, so the bank has a moat. Third is the network effect. Is a service valuable just because everyone else uses it?
Like social media. It's useless if you're the only one on the app.
Exactly. No competitor can steal that network overnight. And the fourth question is generational sustainability. Can you picture your grandparents and your future grandkids using this product?
So like Coca-Cola or Disney.
Exactly.
Okay, so this turns us into everyday detectives, but how do we actually spot these things in real life without a finance degree.
You just observe human behavior. There's this famous story from the book about Peter Lynch. He ran the Magellan Fund at Fidelity and had insane returns.
Right, but he didn't get his best ideas from reading dense Wall Street reports, did he?
No, not at all. The classic story is that his wife came home from the grocery store raving about legs. You know, the pantyhose sold in little plastic eggs.
Yeah. But the genius part wasn't just that she liked them. It was the shift in consumer behavior.
Exactly. She was buying them twice a week at the grocery store instead of every couple of months at a department store.
So he noticed the extreme stickiness of the product. It was literally in her daily path.
Right. So he bought shares in Hanes, the maker of legs, and it became a 30-bagger for his fund.
Meaning the stock went up 30 times its original value, which is wild.
Because the best ideas come from just paying attention to what people actually use.
Okay, but I'm going to push back here a little bit. It's easy to see pantyhose flying off a physical shelf. But in today's digital age, how can you tell if a product is truly sticky or just some passing internet fad?
That is a great question. For the modern age, the book says to look at your recurring monthly expenses. What is completely non-negotiable for you?
My Netflix subscription.
Right. Or video game subscriptions, or even physical habits like buying Chipotle every single Tuesday.
Yeah, I keep paying for those even when money is tight because they're deeply ingrained in my routine.
Exactly. The switching costs and the network effects keep you locked in.
Yeah.
That's modern stickiness.
Okay, here's where it gets really interesting though. Once you spot that sticky product, you can't just blindly buy the stock, right?
Definitely not. You have to verify if the business is healthy and if the stock is actually cheap.
Right, the mechanics. This is where we talk about stock screeners. The book uses a great car buying analogy here.
Yeah, you wouldn't just wander around a massive car lot. You'd use a filter. You'd say, I want a blue four-door car with good gas mileage.
And a stock screener does exactly that for the stock market. You can use free ones like Google Finance, Zacks, or Yahoo Finance.
Right, but the tool doesn't matter as much as the metrics. And the book breaks these into 3 buckets. Is it good? Is it growing? And is it cheap?
Let's break those down. Is it good? What are we looking for?
We want a return on equity, or ROE, greater than 12%.
Yeah.
That just means if you give management $100, they turn it into at least $12 of pure profit.
Efficient management.
Yeah.
Makes sense.
Then you want a gross margin over 30%.
Okay.
That's the difference between what it costs to make something and what they sell it for. High margins mean pricing power.
Which ties right back to the moat.
Exactly. And lastly, for good, an interest coverage ratio above 3. Meaning their earnings are 3 times higher than their debt payments, so they won't go bankrupt if the economy slows down.
Okay, so that's good. What about growing?
You want to see a 5-year revenue growth of greater than 4% per year, so they're selling more stuff.
Right.
And you also want a 5-year earnings per share, or EPS growth, of greater than 4%. So those sales are actually becoming profits, not just covering rising costs.
Okay, and the last bucket, is it cheap?
This is where we look at the PE ratio, the price to earnings ratio. A benchmark for a cheap stock is a PE under 15.
Just to clarify for beginners, PE is basically how many years it takes to earn back your investment. So a PE of 15 means it takes 15 years of profits to pay for the stock. Lower is cheaper.
Exactly. You might also want a dividend yield over 3%, meaning they pay you cash just to hold the stock, and a price-to-book ratio under 2, so you aren't overpaying for their physical assets.
But wait, if I put all of these perfect metrics into a screener, high growth, high margins, low PE, I'm probably going to get 0 results.
Yeah, that's what the book calls the Ferrari under $10,000 rule.
Right. You can't find a perfect luxury car for dirt cheap unless it doesn't have an engine.
Exactly. Trade-offs are required.
So if I find a company with amazing growth but it's expensive, or a cheap company with terrible growth, which side of the seesaw should I lean toward?
Well, it depends on your style. Growth investors will accept a high price tag if they believe the company will keep growing rapidly. Deep value investors ignore growth and just buy dirt cheap, beaten down companies hoping they bounce back.
Got it. It just forces you to be disciplined.
Right. And once you find candidates, you don't have to do it all alone. The book actually encourages cherry picking.
Oh, I love this part. You can just look at what the smartest investors are doing.
Exactly. You can use a site like Guru Focus to legally track what billionaire fund managers are buying, because they have to disclose their holdings to the SEC.
So you can literally just copy Warren Buffett's homework.
Pretty much.
Yeah.
You can also use Seeking Alpha for detailed analyst reports.
And if you hit a paywall on something like the Wall Street Journal, the book has a great trick. You just copy the article title and paste it directly into Google. Usually, clicking through the search results bypasses the paywall.
It's a great little hack. And you can also look at places like Motley Fool for a more humorous take, or Jim Cramer on TV for, infotainment.
But eventually you have to kick the tires yourself. You have to do due diligence.
Yes, you have to go to the company's investor relations page and look at the annual report, specifically the MD&As, the management discussion and analysis.
Right, because legally they have to explain in plain English how the business is doing and what the risks are.
Exactly. You pair that with the segment reporting to see which departments are actually making money, and you track their long-term financials on a site like Morningstar.
But here's my ultimate question. If millions of people are doing all this research, the market aggregates all those opinions into the stock price.
Right.
So how can an average person sitting at home possibly know something the market doesn't?
Because the market is incredibly emotional. Wall Street is obsessed with the short term, like the next 90 days. So when a scary headline drops, algorithms and investors completely panic and sell.
So the panic creates the misunderstandings. It creates the deals we are looking for.
Exactly. If you've done your homework and verified the moat, you have conviction. So when the crowd panics over a short-term issue, you buy. Because a great company and a great stock are two different things in the short term.
Right. A great company might have a terrible stock price for 6 months, but over the long term, the math catches up and it becomes a great stock.
Exactly. It's all about evidence over emotion.
Okay, let's do a quick recap of everything we've covered today. First, we shifted from a passive consumer to a business owner mindset. We learned to avoid the trap of familiar names with no moats, like the Sears and Netscapes of the world.
Yep.
We looked at the 4 moat questions and learned to observe stickiness in our everyday lives, like Peter Lynch did with Legs pantyhose.
Exactly.
Then we talked about running a stock screen to filter for good, growing, and cheap companies using metrics like ROE and PE ratios.
And finally, we learned to cherry pick ideas from the pros, kick the tires by reading the MD&A, and use market panic to our advantage.
Which brings us to a final provocative thought for you to explore on your own.
Yeah, think about your own daily news consumption. Are there any scary headlines right now making people panic about a specific company?
A company whose products you absolutely cannot live without.
Right. What if that panic isn't a warning sign? What if it's the exact treasure map pointing you toward a fundamentally strong company that's suddenly on sale?
Something to really think about. Stop researching the specs of that new TV for a minute and start researching the foundations of the companies you already love. Thank you so much for joining us on this deep dive. Please be sure to like this video, subscribe to our channel, share this discussion with your friends, and support us so we can keep creating more educational finance content for you. See you next time.